Statistics Canada says the annual rate of inflation cooled to 1.7% in July. Lower gas prices leading the decline from 1.9% year over year in June. Now, the agency says prices for gas were down more than 16% year over year, thanks largely to the removal of the consumer carbon tax. But if you're thinking you are paying more for groceries, you are right. Costs rose annually 3.4% at grocery stores. That's up 2.8% from June. Also looking at costs for housing, shelter inflation also saw its first increase since February of last year. It was at 3% in July. Now, for more breaking down these numbers and what it means for you, let's bring in Mauricio Zelaya. He's an economist at Ernst & Young LLP. Mauricio, thank you very much for your time. The first thing that I want to ask you is when we look at something like the Consumer Price Index and how numbers like these that either the Statistics Canada or when you talk about interest rates from the Bank of Canada, they're numbers, but they don't really sometimes tell the whole story for people. Do these numbers indicate that people are paying more for groceries, and could we potentially attribute that to anything yet?
Thank you for having me, and you're absolutely right. The way to think about this is while inflation is slowing down, the actual absolute cost is still quite high. There has been estimates coming that the difference in the grocery bills or prices that we're paying from 2020 to now, it's actually closer to 30% increase or almost a 5% year over year average, which is much higher than the pre-pandemic average that we've seen in the past. Now, it's saying that it's really important to also really unpack those numbers, because you take that a step further, there have been other factors that are at play. So you focus on, say, the rising in grocery bills focused on around 3.5%. You dig in a little bit deeper, you see coffee rising. It's almost about 28%. Now that's very secluded because it's focused more on poor weather conditions, but even fresh fruit is up 4% as well. So it does mean that, well, there may be some easing in household pressure for your budgets in terms of gasoline, but there is still continued pressure on rising in shelter costs, rental rates, and grocery prices as well.
And looking at these numbers, because obviously the Bank of Canada is going to be looking at them very closely right now, you talked about pressure. Well, the leader of the biggest province in Canada by population, Doug Ford, Premier of Ontario, has repeatedly said to the Fed or the Bank of Canada, he wants to see the interest rates starting to be cut. When we look at these numbers right now, I know headline inflation is what people tend to look at as being the big driver. Is it under that 2% threshold the bank said that they wanted? But there are right now a lot of split opinions, it seems, about whether the inflation data we have is a good indicator of interest rates to come. What do you think?
We also have to couple this announcement with what we observed in terms of jobs as well, right? So it's been quite stagnant. And if you look at it's been quite volatile naturally with the geopolitical uncertainty we've been facing here in Canada. But if you look at since the beginning of the year, it's been almost flat. I think we've only had job growth by about 0.1%. So you take that into account, which is another proxy for the Canadian economy, and you also take into account this inflation data, it will tell you a broader story. So my view is, or my opinion rather, is that if we continue to see this trend where there is this core inflation that is slightly below 2%, while jobs are not being created or it's being quite flat, then it would give us an indication that we can expect a cut in the fall.
Well, just thinking about these cuts, Mauricio, and last question here, thinking about people at home that would be wanting to say, well, I want to pay less on my mortgage. I got a variable rate at the height of the pandemic, and I do not have the money to pay for this. They could say that, well, I want to see the interest rate go down. But from an inflationary perspective, does that not create upward pressure on other prices?
Well, and the X factor is what I call it here is also not forgetting the geopolitical issue that we're in right now. So we did not see an agreement or even a tentative agreement with the U.S. in terms of any potential tariff relief. And that will continue to work throughout the Canadian economy. We'll slowly start seeing that inflationary effect come into play. So this is where it gets quite tricky, because you are, in this classical sense, trying to balance inflation with economic activity through the use of monetary policy. So it is a very challenging effect. And that's where the Bank of Canada has been quite conservative in maintaining the rates at the same time.
Mauricio, we appreciate your time. Mauricio Zelaya is an economist with Ernst & Young LLP. Thank you again.
It's a pleasure. Thank you.